Marcus is 31 years old. He earns $78,000 a year. For 6 years, he has lived in a way most people would not tolerate for 6 months. Brown bag lunches, no car payment, roommates long after it stopped being fun. Quiet discipline, repetition, delayed gratification. 3 weeks ago, sitting alone in the parking lot of a Walgreens, he opened his banking app and saw a number he had never seen before. It began with a 1. It was followed by 5 zeros. $100,247. He did not smile. He did not text anyone. He did not step out of the car. He refreshed the screen once just to confirm it wasn't a glitch. Then he stared at it for 11 full minutes. What he felt wasn't pride. It was paralysis. Because now the number demands a decision. His coworker insists crypto is the future. His father says real estate. It worked for his father and his father before him. Finance influencers repeat the same word like a mantra, index funds. And somewhere deeper, quieter, more dangerous, another voice speaks. You've been careful for so long. Maybe you've earned the right to breathe. That voice sounds reasonable, humane, earned. It is also the one most likely to derail everything. The first 90 days after crossing $100,000 quietly determine whether that figure becomes $2 million, or remains a static screenshot from a moment in a parking lot, or remains. Because $100,000 is not merely a psychological milestone. At this threshold, the math changes. Charlie Munger, longtime partner of Warren Buffett at Berkshire Hathaway, was once asked how ordinary people build real wealth. After Buffett's joke faded, Munger leaned toward the microphone and delivered a line that has echoed through personal finance ever since. The first $100,000 is a big call, but you've got to do it. I don't care what you have to do. If it means walking everywhere and not eating anything that wasn't purchased with a coupon, find a way to get your hands on $100,000. After that, you can ease off the gas a little bit. Most people obsess over the suffering in that quote. The grinding, the sacrifice. They ignore the second half. After that, you can ease off the gas. Why? What exists at $100,000 that does not exist at $80,000? Or $50,000? Or $30,000? Structure. At $100,000 invested at an 8% annual return, the portfolio generates $8,000 per year. Without effort, without overtime, without another packed lunch. That is $667 per month appearing because money already earned has been deployed. It now has its own salary. It reports for duty every day. It does not call in sick. It does not panic during volatility. It does not chase trends. It compounds. Assume Marcus continues saving $1,000 per month, on top of that initial $100,000, earning 8% annually. The first $100,000 took him roughly 6.4 years. The second arrives in about 4.2 years. The third in 3.2. By the fifth $100,000 milestone, the gap compresses to roughly 2 years. Same savings rate, same return, no optimization, no brilliance, just scale. Compounding is indifferent to emotion. It only responds to time and capital. Once adequately fueled, it accelerates. Every milestone arrives faster than the one before it, like a boulder that has finally crossed the ridge and no longer requires pushing. And yet most people stop the boulder themselves, not through recklessness, through decisions that feel responsible. There are 3 specific mistakes that derail this momentum. None of them look like mistakes while they're happening. All of them feel prudent, rational, mature. That is precisely why they are dangerous. The first mistake looks like wisdom. Marcus remembers 2020. He remembers headlines, volatility, stories of losses. He worked too hard for this money to watch it shrink. So he transfers the entire $100,000 into a standard savings account at his bank. It feels safe. Every month, he logs in and sees the balance sitting there, stable, untouched, earning perhaps $30 in interest. But the safety is cosmetic. The national average interest rate on standard savings accounts hovers near 0, often below 0.5%. Historical inflation averages closer to 3%. Each year that $100,000 remains in that account, it silently loses purchasing power, but James roughly $2,000 to $3,000 annually in real terms. Nothing dramatic happens, the number does not fall, there is no red warning sign. The balance simply stagnates while inflation erodes what it can buy. Over a decade, that erosion compounds. Meanwhile, $100,000 invested in a simple S&P 500 index fund at historical average returns would grow to approximately $260,000 over 10 years. Marcus does not receive that outcome. He retains something that looks like $100,000, but it buys less. The account appeared safe. It was a slow bleed. That outcome is not speculation. It is arithmetic grounded in historical return data and inflation averages. And it is the most common error at this milestone. Number 3, the ambition trap. The second mistake does not look cautious. It looks intelligent. Marcus now has real capital. 6 figures changes how he sees himself. He begins consuming more financial content. Algorithms respond accordingly. Crypto cycles, AI stocks, real estate syndications, options strategies. A coworker mentions turning $30,000 into something larger through a single concentrated bet. The narrative shifts. He downloads a brokerage app. Midnight research sessions begin. Earnings reports, chart patterns, threads promising asymmetric upside. The idea forms slowly but convincingly. With enough effort, it should be possible to find something mispriced. This is where the data intervenes. Dalbar, a long-running financial research firm, has tracked the performance of average investors compared to the broader market for decades. In 2024, the average equity investor earned 16.5%. The S&P 500 returned 25%, an 8.5 percentage point gap. Not because investors bought fraudulent companies, not because the market collapsed, because they bought after rallies, sold after declines, chased performance, timed entries poorly, allowed emotion to override math. 1 year of an 8.5% gap is noise. 30 years of that gap is devastation. Starting with $100,000, a persistent behavioral underperformance of that magnitude can cost more than $860,000 over 3 decades. The market did not fail. The investor interrupted the process. There is another assumption, that professionals outperform. The Spiva scorecard, which tracks active managers against their benchmarks, reported that 65% of active large-cap fund managers underperformed the S&P 500 in 2024. Over a 15-year period, more than 90% failed to beat it. These are managers with research teams, institutional access, Bloomberg terminals, and advanced degrees. 9 out of 10 do not outperform. The conclusion is not to try harder than they do. It is to stop competing. Own the market. Let aggregate economic growth work without interference. This is not theoretical. It is documented performance data. And yet, ambition tempts intervention. That temptation is expensive. Number 2, the arrival fallacy. The third mistake is quieter. It does not involve risk-taking. It does not involve speculation. It involves relief. Marcus has been disciplined for 6 years. He declined dinners, delayed upgrades, endured inconvenience. Now there is $100,000 in his account. Perhaps the extreme phase is over. He upgrades the apartment. Not extravagant, just better. He eats out slightly more often. Tracking expenses feels less urgent. After all, he must be doing something right. Psychologists describe this as the arrival fallacy. Dr. Tal Ben-Shahar of Harvard defines it as the illusion that reaching a goal produces lasting satisfaction. In reality, the emotional reward fades quickly. The baseline resets. What once felt extraordinary becomes normal. The discipline that built the milestone begins to dissolve. Not dramatically, but incrementally. There is another principle at work. Parkinson's law applied to income. Expenses expand to match available resources. The $100,000 remains invested, but contributions slow. Momentum weakens. 5 years pass. Marcus is now 36 years old with $130,000. He did not squander the money. He did not implode financially. He simply treated a starting line as a finish line. At 8% annual returns with consistent contributions, the account should have doubled or approached it. Instead, it barely moved relative to its potential. Compounding is powerful, but it requires continuity. Interrupt the flow and the acceleration disappears. The mistake was not extravagance. It was complacency. That pattern is not anecdotal. Behavioral finance research repeatedly shows that lifestyle creep following income milestones reduces long-term accumulation rates dramatically. The math was never the problem. The psychology was transition. Everything so far has focused on failure modes. Now the structure shifts, because the difference between $100,000 stagnating and $100,000 compounding into 7 figures is not brilliance. It is order of operations. Get the sequence wrong and tens of thousands evaporate quietly over decades. Get it right and the system compounds almost autonomously. The first move is not investment. It is stabilization. Before a single dollar is deployed into long-term assets, Marcus needs liquidity, 3 to 6 months of living expenses. For a household spending approximately $6,500 per month, that means $20,000 to $40,000 in accessible funds, not in a standard savings account earning fractions of a percent. In a high-yield savings account currently offering roughly 4.0% to 4.2%, APY among the most competitive options. These accounts historically pay 10 to 12 times more than traditional banks for the same liquidity. This is not growth capital. It is shock absorption. Without it, every market downturn feels existential. With it, volatility becomes tolerable. The foundation is defensive. Only then does the offensive strategy begin. Number 1. Capture the guaranteed return. The next move is mathematically unambiguous. If Marcus's employer offers a 401k match, that match is the highest return asset available to him anywhere in the financial system. A 50% employer match is a guaranteed 50% return on contribution. A 100% match is a guaranteed doubling of money before it is. There is no stock, no index fund, No real estate deal, no emerging technology, no speculative cycle that offers a guaranteed 100% return on day one. If Marcus contributes $10,000 and the employer matches dollar for dollar, the account immediately holds dollars. The market has risk has not entered the equation. The return is contractual. Failing to capture the full match is not conservative, it is forfeiting earned compensation. The company offered it. Marcus qualified for it. The only step required is participation. This is not strategy. It is retrieval. That conclusion is grounded in employer retirement plan structures and tax law. It is not opinion. Settle the debt question with math. Emotion distorts debt decisions. The framework is simpler than most narratives suggest. If a debt carries an interest rate above 6% to 8%, eliminate it before investing additional capital. If the rate is below 5%, investing historically produces a higher long-term expected return. Between 5% and 8%, the answer depends on psychological tolerance for volatility. The reasoning is arithmetic. The long-term average annual return of a diversified stock portfolio historically falls between 7% and 10%. Paying off a credit card charging 20% interest delivers a guaranteed 20% return. Nothing stable competes with that. A mortgage at 4% is different. If Marcus can reasonably expect long-term portfolio returns to exceed 4%, the opportunity cost of aggressively paying down that mortgage is meaningful. The critical distinction is certainty. Debt repayment equals a guaranteed return equal to the interest rate. Market investing equals a historically higher return accompanied by volatility. Understanding the difference prevents false comparisons. This framework is consistent with long-term historical return data and lending rates. Tax structure, where most wealth is lost quietly. After liquidity and debt are addressed, the largest silent leak in wealth building is taxation. 3 accounts exist within U.S. tax code that dramatically alter compounding. They are legal, they are underused, and they change long-term outcomes more than stock selection ever will. The Roth IRA. Annual contribution limits generally hover between $7,000 and $7,500 depending on inflation adjustments. Contributions are made with after-tax dollar. Growth is tax-free. Withdrawals in retirement are tax-free. Not deferred, not reduced, eliminated. If Marcus consistently maxes a Roth IRA from age 31 and earns 8% annually, the account can approach $1 million by retirement age. That entire balance is beyond the IRS's reach. The difference between tax-deferred and tax-free over decades is not incremental. It is exponential. If income exceeds Roth IRA eligibility thresholds, typically phasing out for single filers between roughly $146,000 and $161,000, the backdoor Roth strategy remains available. Contribute non-deductible dollars to a traditional IRA. Convert them to a Roth IRA, file the appropriate form. The end state is identical. This is permitted under current tax law, the health savings account. The HSA is structurally unique. It carries a triple tax advantage. Contributions are tax-deductible. Growth is tax-free. Withdrawals for qualified medical expenses are tax-free at any age. After age 65, withdrawals for non-medical purposes are treated like a traditional IRA. Taxed as ordinary income, no penalty. There are no required minimum distributions. Balances roll over indefinitely. Annual contribution limits sit roughly around $4,300 for individuals and over $8,500 for families, subject to inflation adjustments. The optimal strategy is counterintuitive. If Marcus can afford to pay medical expenses out of pocket from checking, he should do so. Keep every receipt. Allow the HSA to remain invested in low-cost index funds for decades. There is no time limit on reimbursing oneself for qualified expenses. At 65, he can withdraw accumulated growth by reimbursing decades-old receipts. The account becomes a parallel retirement vehicle, one the IRS explicitly authorizes. This is not a loophole. It is written policy. Maximize the 401k beyond the employer match. The employee contribution limit currently exceeds $23,000 annually. Combined with employer contributions, total additions can approach $70,000 per year. That is capital compounding in a tax-advantaged environment, shielded from annual taxation on dividends and gains. Over decades, this shielding meaningfully increases net outcomes. None of this is exotic. It is structural. Once these accounts are maximized, excess capital flows to a taxable brokerage account. And here is where complexity often destroys progress. The answer is minimalism. 3 funds, a total U.S. stock market index fund such as VTI, a total international stock market fund such as VXUS, a total bond market fund such as BND. Together, these funds hold roughly 22,000 securities across global markets. The total annual expense ratio approximates 0.04%. On $100,000, that is about $40 per year. By comparison, the average actively managed fund charges roughly 10 times more. And over 15 years, more than 90% of active managers fail to outperform the S&P 500, according to SPIVA data. Paying more for statistically lower performance is not sophistication. It is friction. Owning the entire market removes prediction from the equation. Growth becomes tied to global economic expansion, not personal insight. This strategy is supported by a century of aggregated market return data. It is boring. It works. Real estate. When $100,000 changes the equation. At six figures, real estate becomes possible. But most people approach it backwards. They imagine purchasing a single-family home as an investment, renting it out and waiting for appreciation. In many markets, median home prices now exceed $400,000. Interest rates fluctuate. Margins compress. Competition intensifies. The math is tighter than it appears. There is another structure that alters the equation entirely. House hacking. Marcus purchases a duplex. He occupies one unit and rents the other. Under FHA guidelines, multi-unit properties up to 4 units qualify for as little as 3.5% down, provided the buyer lives in one unit. On a $400,000 duplex, 3.5% down is $14,000. If the second unit rents for $1,800 to $2,200 per month, and total mortgage plus expenses fall between $3,000 and $3,200, Marcus's effective housing cost declines to approximately $1,000 to $1,400 monthly. He is building equity. A tenant is covering the majority of the mortgage, and the majority of his $100,000 remains invested elsewhere. It is not glamorous. The neighbor is also the tenant. Privacy shifts. Maintenance becomes personal. But the wealth-building math is difficult to dispute. If landlord responsibility is intolerable, exposure to real estate can still be obtained through REITs. For example, VNQ, Vanguard's real estate ETF, holds roughly 158 real estate assets, carries an expense ratio around 0.13%, and historically yields approximately 3.8% in dividends. It offers liquid participation in real estate returns without midnight repair calls. Not identical to direct ownership, but frictionless. Both paths are grounded in established lending rules and publicly available fund data. The psychological turning point. 6 years ago, Marcus was manually constructing wealth. Every dollar required a discipline. Every decision felt like sacrifice. Effort directly translated into balanced growth. That era has ended. At $100,000 invested at 8%, the portfolio generates approximately $8,000 per year independently. At $500,000, the same 8% produces $40,000 annually. At $1 million, it generates $80,000 per year, roughly equivalent to Marcus's current salary. Without additional labor, the transformation is subtle but irreversible. The money begins to resemble a force rather than a number. The individuals who successfully cross from 6 figures to 7 do not typically discover superior investments. They remain relentlessly boring. They automate contributions. They route half of every raise directly into investments before lifestyle absorbs it. They ignore market noise. They refuse to treat a milestone as a finish line. They protect the psychological ground already won. The second $100,000 arrives roughly 35% faster than the first under consistent savings and compounding. The third arrives faster still. Acceleration only persists if the system remains intact. Marcus does not require brilliance from this point forward. He requires structure, accounts established, contributions automated, interference minimized. The hardest task in personal finance is rarely selection. It is restraint. Charlie Munger's statement about easing off the gas was never permission to disengage. It was recognition that the grinding phase, the scraping together of initial capital, is structurally different from what follows. After $100,000, the process becomes quieter, less dramatic, more powerful. Money transitions from object to engine. The parking lot moment was not a culmination. It was ignition. And ignition left undisturbed compounds.